Well, let's get our first guest on the show. Nathan Sheets, Global Chief Economist at Citi, joins us now to give us his view on the markets and how things are shaped up from here. Nathan, hi, good morning, and thanks a lot for joining in on the show. The markets so far have been fine. It, in fact, was a broad-based rally that we saw on Wall Street overnight. But how are you feeling about the remainder of this calendar year? Because risky assets like equities have done well up until now. Do you think now things are going to start getting a bit tough?
Well, as you say, the markets have been very, very aggressively priced. Let's put it that way. And even today, we saw that with these hot inflation data, and the S&P rising further. And I think the markets are, looking at the silver lining here. That these inflation data were hot. But they were not as hot as January and not as hot as maybe had been feared. And I think that's broadly the tone right now, where the markets are inclined to see the positive. And I think the underlying driver of that is market participants are looking forward to Fed rate cuts. And these data that we got on inflation will give the Fed pause, but it doesn't change the basic narrative. And we continue to expect, as do the markets and many others, that the Fed is going to cut in the middle of the year, and there will likely be a couple of rate cuts even beyond that. So I think that's the driver, and I think that that's likely to continue to support the markets for quite some time.
All right. Hi, Mr. Sheets. Good morning and good to see you in. So you're factoring in a rate cut in the middle of the year and a couple of that post that. But what about an emerging market like India? Equity valuations, they're trading at elevated levels, but earnings growth as well has been fairly good out here in India. Your view on the Indian markets, and how is this toss-up shaping between India, which is a relatively expensive market, but far more stable and has a good structural story, while China, the one that's bombed out, but there is hope that there could be some policy measures. Your take.
My sense is that we are at a point where global investors' sentiment toward India is very strong. The most positive that I can remember in my career. And I think that the underlying dynamic is twofold. First, investors are seeing strong growth performance in India and underlying structural reforms that are supporting the performance of the economy. And by the same token, I think that there is a bid for assets in places other than China for geopolitical reasons, for diversification reasons, for a variety of reasons. I think global investors are increasingly thinking about what are some other jurisdictions beyond China where I can invest. And I think India has been a beneficiary of that. Last week I was in Mexico. I think Mexico is a beneficiary of that. And I think given the geopolitical realities, that is likely to be a fairly durable source of demand for Indian assets for quite some time to come.
Well, Mr. Sheets, while the optimism for India is high, so is the price, because while on the one hand, everyone wants a slice of India, there are a lot of global companies, they're selling their slices of India, perhaps doing that valuation arbitrage. We've seen that in the very recent past as well. So what would your advice to clients be? Even as the optimism is high, what would their, entry strategy into India be at these prices? How should one deploy money?
I think the key is what you mentioned before. It's the key for the Indian market. It's the key for the U.S. market. And it really boils down to the durability of earnings. So when I think about valuations in global equity markets, and when I think about valuations in the Indian market, my guidance, my advice would be for investors to kick the tires on earnings projections and make sure they're comfortable with them. If we continue to have a solid global economy and solid earnings in the corporate sector, I think it's likely to support, the valuations, broadly speaking, that we see. But if those earnings falter, then I think we're likely to move into a different kind of regime, and some of the pricing that we see could be problematic.
Got it. Thanks a lot for joining in, though. I appreciate your time here on CNBC TV 18.